Awesome. So today we're going to be talking about really inheritances as a broad topic, but very specifically talking about inheriting IRAs, inheriting retirement accounts in retirement, how to plan around the rules. There's different required minimum distributions for every type of account, and even when you receive that inheritance. There are two essential estate planning regimes that we now need to plan under. And so we're going to be covering this from a bunch of different angles. It can be confusing. So if you guys have any questions, go ahead, put them in the comments. We'll make sure that we talk through any questions you guys have. If everything's not making sense, I can spend more time on that given slide as well. So let's go ahead and get started. And again, we're going to be kind of going through this at a reasonable pace here. So, okay. So just like you have to take RMDs, required minimum distributions, on your own accounts, on your own traditional IRAs, you also are required to take minimum distributions off inherited retirement accounts. So that includes both traditional IRAs as well as Roth IRAs, and really just any tax deferred account in general. So if you inherited a 401k as well, that will have an RMD at some point in the future. And these rules change based on when that account owner passed away. Okay, we'll talk about essentially the two different estate planning regimes we now have to plan under. And so there is a 50% penalty for non-compliance or miscalculation. So let's say in a given year, you have to take a $10,000 RMD from your retirement assets. Okay, and let's say you only take a $5,000 RMD. Well, you're essentially off by $5,000. And so you're going to owe a penalty, 50% of that essentially miscalculation you're going to owe as a tax. So in that scenario, $2,500. And so there is a steep penalty for non-compliance, for miscalculation. So we need to make sure we're getting that RMD right each and every year. Also know you can always take more than your RMD requires. And so again, I know some retirees that do that just to make sure they're not miscalculated and thus receiving a penalty. So just know you can always take more than your RMD requires in a year, just like with your own accounts. But it's important to note that you can't convert a non-spouse inherited IRA to a Roth. So let's say that you inherit a $150,000 IRA from your dad, let's say. Okay, well, you can't convert that IRA to a Roth and try to avoid being taxed on those RMDs later on. You have to withdraw the entire amount. Obviously, you can't put that then in a Roth because of contribution limits. And so that's an important thing to note, because you can convert your own accounts. Okay, and so there's really two inherited IRA regimes that we have to plan under. Essentially, these two different sets of rules were created because in 2019, basically a week before Christmas, while many of us were preparing for the holidays, preparing for family, Congress was hard at work, and underneath the door, they essentially slipped in something called the Secure Act. And this was a huge watershed estate planning law that completely changed the rules around inherited IRAs, around RMD rules, and everything in between. And so essentially, you might have to take RMDs on two different sets of rules. Okay, so for instance, when did the account owner pass away? If they passed away before January 1st, 2020, you have to comply with the old rules. Okay, and again, you should have been complying with the old rules this entire time, because again, they would have had to pass away more than a year and a half ago. If they pass away after January 1st, 2020, so any future inheritances you receive or inheritances you've received for the last year and a half, you now have to comply with the Secure Act rules. And both of these rules are wildly different rules. Okay, so we're going to talk through each of those rules, go through a bunch of examples, and then we're going to talk through strategies for receiving an inheritance, different tax planning hurdles that you need to overcome when you actually receive that inheritance, or if you pass on an inheritance to the next generation as well. So let's talk through the pre-2020 rules, so pre-Secure Act rules. And again, you should have been complying with these rules thus far, because if you receive an inheritance from an owner that was passed away before January 1st, 2020, obviously you would have had to take some RMDs so far. And just so you know, if there's any noise in the background, that's the air conditioner going off. So sorry about that if that's pretty loud, but I do have a new microphone as well that should help with not picking up some of that background noise. Okay, So these pre-2020 rules are a lot more forgiving tax-wise, but they are more complex. And again, this applies to both Roth IRAs as well as traditional IRAs. You are required to distribute so much of each of those accounts as you receive them as inheritances. And these rules will vary depending on essentially two factors. One, if you're a spouse of the deceased, I'm guessing that's not going to be as big of an issue here. So we're not going to talk as much about spousal rules for pre-2020 rules. We're going to generally talk about if you're a non-spouse and you inherited an IRA. Okay. The second rule will vary if the deceased was taking RMDs. So if they were over 70 and a half taking RMDs, again, there's some different changes to the rules, but just note for all inherited accounts, RMDs, whether it's pre-2020 rules or post-2020 rules, or I should say pre-Secure Act or post-Secure Act rules, RMDs must begin by December 31st of the following year of their death. Okay, so let's say someone passed away tomorrow, you inherit an IRA. Okay, you won't have to take an RMD yourself for 2021. You'll have to take it for 2022. Okay, and we'll talk about some variations on that as well. But a common term you'll also often hear quoted around estate planning rules is required beginning date, RBD. And basically what that means is, as simplistically as possible, was the deceased receiving required minimum distributions? If they were receiving required minimum distributions, they are past their RBD date. If they weren't, they pass away before their RBD date. Okay, so let's talk through if you received if you're a non-spouse and you received an inherited IRA and they were older than their RBD date, so they were receiving RMDs. Okay, you have to take the owner's RMD in the year of death. Okay, so let's say someone passed away this year, they were receiving, or let's say they passed away in 2019, because we're talking about pre-Secure Act rules, and they were receiving RMDs. Okay, you have to take their RMD for the given year. You don't get out of their RMD because, again, they were set to have to take an RMD for that year. So you have to take the RMD based on their RMD table, their single RMD table. Okay, then you use the age of whomever is younger between you and the deceased. Typically, it's almost always going to be you. So if you inherited a parent's IRA or you inherited an uncle or an aunt, some relative, typically that person is older than you. Again, just statistically speaking. So you use whoever's age is younger. Let's just say it's your age. You plug your age into what's called the single life expectancy RMD table. You can look this up. It's an IRS table that they lay out. And you basically use this life expectancy table to calculate your first RMD. And then for every subsequent RMD, you reduce the life expectancy factor by 1. And I know this is confusing when I just have these rules in text. We're going to go through some examples that's going to clear all of this up. The information you need to calculate your first RMD are the deceased owner's date of birth and date of death, and then your date of birth. Okay, so let's go through an example of what this might look like. So Pam's uncle was 75. He passed away in 2018. Pam inherited a $308,000 IRA. Okay, so in 2018, Pam is going to have to take the RMD that Pam's uncle was set to take. So let's say he passed away in July. By the end of the year, she's going to have to take that RMD based on his, again, normal RMD schedule. But then Pam turns 58 in 2018. Her first inherited RMD will be in 2019. Because again, if he passed away in 2018, it's the following year that she now has to take that RMD for the inherited RMD, okay? So at the end of 2018, let's say the account grew from 308,000 to 315,000. Well, when Pam has to take her first RMD in 2019, she's going to be 59 years old. Okay, and let me just get out my drawing tool because I'm sure I'm going to have to use that at some point. She's going to be 59 in 2019. So you download or look at the single life expectancy table. Again, you can find this on the IRS's website. Find your age and in the year you have to take that RMD, and then find what's called the life expectancy factor. And it's very simple what you do with this life expectancy factor. You take the account balance at the end of the previous year, so at the end of 2018, and you divide it by this life expectancy factor. So we take 315,000 divided by 26.1, and her first RMD in 2019 would be $12,068, okay, that she would be forced to take from that account. Okay, so again, I know these rules can be a little bit complex and confusing. Basically, in the year that the uncle passes away, if he's over his RBD date, which he would be because he's 75, at that point it would have been 70 and a half. Pam has to take his laid out RMD. The following year, she has to take her first inherited RMD. Okay, she takes the account, looks up her life expectancy value in this table, divides the account balance at the end of the year by this life expectancy factor. She received, and you calculate your first RMD that way. What about all subsequent years? So her first inherited RMD, the life expectancy factor was 26.1. Well, you essentially reduce it by 1 for every subsequent year. Okay, the idea being by the time you get, let's say 26 years later, you're essentially supposed to be withdrawing that entire account. Okay, so again, this is a weird ripple that you decrease it by 1. Again, these are the confusing old rules that they have. So let's say the owner had not reached their required beginning date before passing away. So in this previous example, let's say her uncle was 68 years old. Okay, well, Pam now essentially has 2 different options. Pam can use the single life expectancy table as previously shown, basically the same rules and calculation we just went over would apply, or she can take the entire account balance out by the end of the 5th year. So she has to choose whichever one she's going to do when she inherits the account and whatnot. Okay, so a few more options if that person had not reached their RBD date. And so let's clear up the rules, okay, quickly. These rules, the rules we just covered, only apply if you inherited an IRA or a Roth IRA prior to January 1st, 2020. Okay, and hopefully you've been following these rules. I know that RMD calculation can be confusing. There's some great calculators out there that will allow you to plug in the account value, allow you to plug in the birth date, the death date, and then your birth date, and figure that out for you. Okay, so it doesn't have to be as confusing as going through each of these steps, but you should have already been receiving those RMDs. Just know you didn't need to take one in 2020. So if you missed it in 2020 or you intentionally didn't take it, you didn't have to. Okay, all inheritances going forward will be based on the Secure Act changes. Well, what are the Secure Act changes? Well, they're simpler in some ways, but can be a real tax planning nightmare. Okay, we'll talk about why, but essentially they're simpler as far as the rules that you have to follow for RMDs. They can be a little bit more complex because they essentially created 3 different types of beneficiaries now, and each have a different set of rules. Okay, so what are the 3 types of beneficiaries, the 3 classes of beneficiaries? You first have what would be called beneficiary royalty, they're often referred to. They have the most options when deciding how to take their RMDs. This would be this first category here. Okay, and the most common person in this eligible designated beneficiary category is going to be spouses. Okay, there's some other people that qualify for this, like minor children. I'm guessing most people watching this don't have minor children still. If you're around that retirement age, disabled or chronically ill people also qualify for this as far as beneficiaries. And then someone that you're passing the money on to, an heir that's not more than 10 years younger. So again, for most people, it's going to be spouses that fit into this category. Category 2 is a designated beneficiary. This will be the most common, basically, if you're a non-spouse. So if you receive an inheritance from your parents, from relatives, and they're not your spouse, you'll fit into this category. And then finally, 3 is the worst category. You don't want to fit into this category. This would be non-designated beneficiary. This is typically when you receive an account, but you weren't named as the beneficiary. You received it through the estate, through their will. Okay, so let's talk through a couple different examples and different rules that apply. We'll start with the most common class, which will be designated beneficiaries. So this would be, the most common example would be if you inherit an IRA from a parent. And this is the common 10-year rule that you might have heard talked about around the Secure Act. Basically, this rule, whether it's a Roth IRA or a traditional IRA, stipulates that you don't have to take certain RMDs each year. You just have to exhaust the entire account within 10 years. Okay, so you can take a lump sum distribution. You can take it all out right away in the first year. You can wait until the final year to take that out. Anywhere in between, you can take periodic withdrawals. You just have to exhaust that entire account, pull all of the money out within 10 years. And again, there's a 50% penalty for non-compliance. So if you inherit an IRA, let's say it's a $200,000 IRA, and you just don't take any of that money out, and 10 years lapses, you miscalculated, maybe you were planning on taking it all out in the 11th year. Well, guess what? You have a 50% penalty. So in that example, with a $200,000 account, you would owe $100,000 as a penalty. Okay, so let's go through an example. Dave's dad, he's 82. He passed away in 2021 with a $432,000 traditional IRA. Now, Dave inherited the full IRA through a beneficiary form. So when you set up an IRA, you fill out a beneficiary form, or at least you should be. Okay, on that beneficiary form in this example, Dave was the sole beneficiary. So Dave must distribute this full $432,000 account plus any growth within 10 years. And again, he can do it any way he wants. We'll talk about some planning hurdles that you need to plan around a little bit later in this presentation. Okay, but it's pretty simple. 10 years, there's no requirement each year what he has to distribute. He has 10 years to distribute the full amount. Okay. The next one we'll talk about is very similar rules with one very clear distinction. Okay. This would be an NEDB, or a non-eligible designated beneficiary. The most common example is you leave your retirement account to your estate. So on your beneficiary form, you either don't fill it out or you write your estate on the beneficiary form. And I find that there are quite a few retirees that have this designation right now, because under the old rules, it was fine. Under the new rules, the Secure Act rules, this is an estate planning nightmare. Okay, so mark down, you definitely don't want to break this rule. You do not want to pass retirement accounts on to your estate. The reason why is because the 10-year rule base cuts in half. It now becomes a 5-year distribution rule. So same rules. You don't have to distribute any certain amount in a given year, but you have 5 years to distribute the full amount. So same rules apply. It applies to tax deferred accounts and Roth IRAs, 50% penalty for non-compliance. So let's use that same example. Dave's dad, 82, passes away in 2021 with $432,000 traditional IRA. But this time, Dave still inherits the full IRA, but the IRA's beneficiary form laid out the will. Dave's dad laid out, he wants essentially it going to their estate. They have a will that specifies Dave will receive that IRA. Well, because he wasn't, because he's now classified as a non-eligible designated beneficiary, he has to distribute that full account within 5 years. And so you go from, let's say you had 10 years, at the very least, you're distributing, if you were doing it equally, anywhere between $40,000 to $60,000 a year when we factor in growth. Well, now that he only has 5 years, he's looking at closer to $80,000 to $100,000 a year that he has to distribute, which is a significant additional amount of money that he now has to, they now have to distribute. Okay. Probably is going to jump them into the next tax bracket, could cause their Social Security benefit to be taxed, could cause all of these different tax hurdles. Okay. The third one we'll spend a little bit more time on: eligible designated beneficiary. This is the beneficiary royalty. This is the most common example here would be your spouse. Okay. And there's essentially 3 options that a spouse has when they inherit their deceased spouse's accounts. Okay. They can retitle, they can do a spousal rollover, they can be treated as a beneficiary. So option 1, and I'm going to refer to these as we go through a few examples. Option 1 would be they simply roll over their spouse's account into their account. Okay, so if they have a traditional IRA, they roll over the deceased spouse's traditional IRA into their traditional IRA. That is completely fine. Number 2 would be the spouse retitles the account and treats it as his or her own. So you have a traditional IRA, your spouse has a traditional IRA, your spouse passes away. Okay, you can retitle this spouse's account to be now your account. So now essentially the same thing happens as option one, only you have 2 IRAs instead of 1 IRA. Okay. And then finally, a spouse can choose to treat that IRA as an inherited IRA and remain a beneficiary. And there's some interesting ripples that happen in some specific planning cases. So let's go through in a few examples. Janet and Scott are married. Janet is 63, Scott is 66. Scott passes away at 66 and leaves his $684,000 IRA to Janet. Scott's obviously younger than his RBD date, which would be 72. So he has not reached it yet. Janet elects to roll Scott's IRA, $684,000, into her IRA, which is $545,000. Excuse me. Okay, so Janet's now essentially going to have, in option one, she's going to have a $1.2 million IRA. Okay, so Janet isn't going to be forced to take any RMDs out. She's not going to be forced to comply to the 10-year rule. This account is now treated as if it's Jan's. So Janet now has a $1.2 million IRA. She will not have to begin RMDs until she reaches age 72. Okay, pretty simple. If Janet retitled the IRA into her name, basically what would happen, she would now have 2 IRAs totaling $1.2 million. Same thing would happen. She would not be required to take any RMDs until she reaches age 72. And then again, those RMDs, even though there's those IRAs, even though there's 2 IRA accounts, would both be treated as if they're just her accounts. Okay. So again, spouses have a little bit extra ability. They don't have to follow any 10-year rules. Basically, they inherit the account, treat it like it's their account from the beginning. Let's go through another example. Let's say that Janet is 73. Okay, everything else is the same. Scott has still not reached his RBD date. Janet elects to roll those IRAs together to make that $1.2 million account. What happens? Well, because Janet now is older than her RMD age, she is going to basically start paying RMDs out or having to take RMDs out from that $1.2 million account. So the only thing that changed is now Janet has to take out RMDs, but that's because she's 72. Okay. If Janet retitled that account into her name, the same thing would happen. She'd still have to take out RMDs on that full $1.2 million, $1.2 million of value, if you will. John asks, is it accurate IRAs left directly to children have 10 years to exhaust the funds? IRAs left to a trust must be withdrawn within 5 years. Yes, on the first half of that. So IRAs left directly to children have to be exhausted within the first 10 years. IRAs left to a trust, it depends on the trust. Okay, so certain trusts will be classified as a non-eligible designated beneficiary, and they'll have to follow those 5-year rules. Certain trusts will be classified as a designated beneficiary, and they'll follow the 10-year rules. So it varies widely. We'll probably do an entire presentation on talking about which trusts qualify for which designations. But great question. It depends, though. It depends on leaving that to a trust. Okay. I can answer more thoroughly in the comments after this, for sure. So let's go through example number 2 of an eligible designated beneficiary. Beth and Frank are married. Beth passes away and leaves her almost $1 million IRA to Frank. Beth is 75, Frank is 70. Okay. So Beth is over her RBD age at her passing. Frank elects to roll those accounts together. So again, it's going to be an almost $1.2 million account. What happens? Well, Frank will have to take, in the year that she passes away, Frank will have to take her RMD that she was supposed to take. Again, because she's over 72, she's going to be taking an RMD. Frank is going to have to take her RMD in that given year. But then moving forward, because Frank is not 72 yet, he is going to have a few years before he turns 72 and then has to take RMDs off that full $1.2 million balance. Okay, so again, he's not having to take ongoing RMDs until he reaches 72. Same thing happens with option 2. The only difference is he has two accounts now, but they are aggregated together for RMD purposes. Okay, let's go through a third example. John and Kathy are married. John passes away and leaves his almost $800,000 IRA to Kathy. Kathy is 76. John is 70. So interestingly, this is kind of the flipped example. John has not reached his RBD age, but Kathy has. So Kathy is inheriting that $800,000. Okay, so Kathy, if Kathy inherited it and just rolled those accounts together, she would have to immediately begin RMDs because she is over 72. She would be the sole owner of those accounts. Instead, Kathy elects to not roll her IRA into her name because she doesn't want to begin RMDs on John's IRAs next year. She instead chooses to remain a beneficiary. Basically, what is going to happen is now the RMDs are going to be based off John's age. So she's going to have a little bit before she has to start taking those RMDs. Okay, so there's, again, three different options you have as a spouse. Let's go through a few do nots, if you will, horror stories, if you will. Always make sure when you inherit an account, so most likely what's going to happen when you inherit an account is that account is going to be at whoever, well, let's just actually go through this example. Ted Smith inherited an IRA from his dad, Bill Smith. Bill Smith likely has a different advisor. Let's say he's working with Edward Jones and Ted Smith is, has his money custodied at Charles Schwab. Okay, so Ted will likely take his inherited IRA from Morgan Stanley, transfer it to where his other money is held. Well, it's very important that you title the account correctly when it comes to wherever it's currently being held. Oftentimes, or sometimes we see people just thinking, okay, it's an IRA that I'm inheriting. I have an IRA. Let's just throw it into my IRA. And so they'll title it something like Ted Smith IRA. You absolutely do not want to do this. The reason being is because if you do this wrong, the IRS will treat this as if it was a full distribution. So let's say that Ted inherited a $100,000 IRA and he titled it incorrectly. Well, essentially it's going to be treated as if Ted took a $100,000 distribution from that IRA. So you definitely do not want to do this. Here's what you want to label it as. You want to make sure it's an inherited or beneficiary account. Every custodian is different how they classify it. You then want to label it something like John Smith IRA, deceased December 15th, 2020, for the benefit of FBO, Ted Smith beneficiary. Okay, so this is the correct way to title an account. Make sure you're not titling it incorrectly. And then we touched on never pass your IRA to your estate, depending on your will to distribute it how you want. Okay, why? Well, you're going to be subject to the 5-year rule. So you get half the amount of time. There's probate expenses. There's potentially estate income taxes as well. So you definitely do not want to pass an IRA to your estate. Okay, so let's kind of touch on the planning side of it, because I think this is one of the most under-recognized parts of inheriting money. And I would argue the most important part of inherited money, okay? So let's walk through an example together. We have Ray. Ray is 62. We have Veronica. She is 63. They're planning on retiring this year. They look very happy about it over here, okay? They're aiming for a goal income of $75,000 net of taxes and healthcare. They have sizable savings. So together they've saved $2.1 million and 1.9 of it is in tax deferred accounts. Okay, the rest of it is in taxable accounts. So they have a lot of money, but it's very concentrated in traditional IRAs, 401ks, and whatnot. That's going to be very important from a tax planning scenario. Now, Ray has a $20,000 pension, and at some point in the future, they expect an inheritance of $500,000. Okay, so let's just walk through their situation from a planning standpoint. First, look at their situation. Again, they're in a pretty good situation with the pension, with Social Security, with sizable savings. This is more of a situation where we're fine-tuning and tax planning to make sure they keep the majority of their assets in their retirement. So we see by the end of their life in current dollars, we expect them to have $2 million. So this is in current dollars. When we inflate this into the future, this might be something like $4 or $5 million that they actually pass away with. Okay, and here's the big issue with their retirement. And I likely didn't even need to indicate this for some of you. is RMDs. They have the majority of their assets in tax deferred accounts. And so once they turn 72, they're going to be forced to take from their traditional IRAs because of RMDs. Well, we see that these RMDs push them to take out more income than they need. This is very tax inefficient. This is going to run some tax havoc on their plan. Okay, and we can see this with this quick snapshot. What you see here are these tax brackets shown through time and where their income is going to fall. Okay, so early in retirement, they're going to be planning around Affordable Care Act insurance. Then they're essentially going to have a period where they're withdrawing from their assets while they're delaying Social Security. And we see once they're 72, these green bars once again are pushing them not only into the next tax bracket, but even, even into the next tax bracket way out here. Okay, it's important to note that right about here, the Tax Cuts and Jobs Act expires. So the 22% brackets turning into the 25, 24 is turning into the 28. And so we see here early in retirement, they're not going to be paying much in taxes. Later in retirement, because of RMDs, they're going to be in a tax nightmare. Okay. So what can they do? How can we plan around this? Again, this is just going over their retirement situation. Well, from 2021 to 2024, they're going to be on Obamacare insurance, ACA. So they're going to try to keep their income low to earn a subsidy. By earning a subsidy, they're essentially going to lower their healthcare premiums by about $1,000 a month, $12,000 for the year. Okay, from the time they're both on Medicare then in 2024 to the time they're both on Social Security is essentially this optimal Roth conversion zone. So we're going to want to be performing a Roth conversion to lower RMDs later on and keep money in tax never again accounts. Okay, so Roth conversions are happening through here. They're both going to be on Social Security then in 2029. RMDs begin then in 2030. Okay, so what does this look like? Well, essentially, it's going to look like we're going to be converting for about 5 years here. Again, keeping their taxable income very low, reported income, I should say, very low over here because of qualifying for a subsidy. Once they're both on Medicare, we're going to be performing large Roth conversions, maxing the 24% bracket, for the first 2 years right here. Why? Because they're going to still be, we're still going to be planning under the Tax Cuts and Jobs Act. So we're converting at 24% in order to avoid 25 and 28% later on. Makes a lot of sense. Well, once the Tax Cuts and Jobs Act expires, they're going to be converting up to the 22, maxing the 22% bracket here. And so basically these Roth conversions are going to result in $350,000 in tax savings. RMDs over here, you'll see are kept low. Okay, much more manageable. It's going to save them again, $350,000 just in tax savings. Okay, so from a planning standpoint, we fixed some of their issues or at least minimize a lot of their issues. Things are looking good. What happens though? Ray's mom passes away in 2021. So they're going to have to follow the Secure Act rules, 10-year distribution rules. They're going to inherit a $500,000 IRA. My question to you is, when can they afford to take their RMDs? Okay, because now a situation we could have just fixed now blows up from a tax planning side of things. Okay, so they inherit this money in 2021. They have 10 years to use this money up. So essentially early 2030s, they'll have to exhaust this entire $500,000. Well, I can tell you what isn't going to make sense is simply taking periodic, equal periodic RMDs from this account. So the last thing they would want to do is take $50,000 a year. Why? Because they're going to be losing a subsidy through here. Okay. Again, because they're going to, taking that money from that IRA is going to cause them to report a much higher income, essentially going to lose out on the subsidy here. Well, if they take their distributions through here, that might work, okay? But now they're not going to be able to perform those Roth conversions because every dollar they take from this IRA is going to be a dollar they can't use as Roth conversions without paying more taxes. And so this isn't really going to work that well because we're performing Roth conversions to save on their RMDs later on, and they're forced to take a different amount from this IRA. Well, and again, leaving it when they're both on Social Security, not a great idea. Why? Well, it's going to force them into the tax torpedo. And so they don't have a great zone here where they can take those withdrawals from that $500,000 IRA without throwing their situation into a huge mess. What's likely going to be the solution? They're probably going to have to take distributions over here, pay the lose their subsidy. That's going to be a $12,000 a year loss. Add that back in as a tax, but they're still going to need to do the Roth conversions on their own situation, or from the time they turn 72 to when they pass away, they're just going to be in a tax nightmare for themselves. And so this is why it's so important to start to plan for inheritances prior to receiving that inheritance. Obviously, we don't know the exact time Ray was going to receive this inheritance, but we knew his mother was getting up there in age. We knew the risk was only getting higher each and every year. And so Ray didn't have a plan for this situation, and now his retirement plan has to completely change. Any way you slice it, he's going to be owing much more in taxes because of this $500,000 IRA. Now, that being said, he's still going to end up better than he is. Okay, let's take a drastic example. Let's say that this causes him to owe an extra $250,000 in taxes. Well, he's still getting an extra $250,000 as an inheritance. So the inheritance still adds value to his retirement. The point here being, we want to get as much value from that inheritance as possible. And depending on depending on your situation, that can be very hard to do if that inheritance comes at the wrong time. Okay, so what strategies can you use to take inherited RMDs, take inherited accounts properly without messing up your situation? Well, number one, which offers the single most, or by far the most options, is what I would call multi-generational planning. So this will happen both when you're thinking about passing on an inheritance to your children, but also if you're thinking about getting you will get an inheritance from your parents or from a relative that you have. Ideally, you want to start planning well ahead of time. And so what I mean by multi-generational planning is, let's say you're going to inherit money. Take Ray's example. He's going to inherit $500,000 from his mom. They have their own situation, and they're set up very well themselves. Well, they should be having conversations with Ray's mom prior to her passing. Okay, probably 10 years before she has a huge risk of passing away, and start talking through the best way to handle these inheritances. Okay, so for instance, who ideally should be paying the taxes? Well, we see that Veronica and Ray have a ton of tax planning they need to do for themselves. So it might be in a situation where Ray's mom should have been performing Roth conversions well ahead of time. Passing on a $500,000 Roth IRA doesn't change Ray and Veronica's plan at all. Passing on a traditional IRA will, because they're forced to take income and pay taxes on that income from that traditional IRA. They wouldn't be from that Roth IRA. So it's very important with this multi-generational planning to figure out who should be paying the taxes on that inheritance. Somebody is going to with a traditional IRA. Okay, ideally, you want the majority of that inheritance to pass on to your heirs. That's the whole point of that inheritance, is to pass as much on as possible, keep the most in the family, the least in Uncle Sam's pocket. The other thing as well, will you benefit by inheriting specific accounts versus other beneficiaries? Let's say that Ray had a brother and a sister, so three beneficiaries. Let's say Ray's mom is passing out a few different accounts, a taxable account, a Roth account, and a traditional IRA. Well, if each of those beneficiaries, are in a different tax situation, and let's say that Ray's situation is the worst tax planning wise, well, maybe it benefits Ray the most to get the Roth IRA, even if the Roth IRA is $350,000 versus $500,000, or $400 versus $500. Maybe it makes sense for Ray to get the taxable account, because if you pass on a taxable account, there's a step up in basis. So with each of these beneficiaries, and each of these beneficiaries having a different tax situation, it might make the most sense to pass on specific accounts to specific people. If somebody's in a very low tax bracket, they should have the inherited IRA, the traditional IRA, passed to them. Okay, if there's not as much tax planning that needs to go on their situation. So again, passing the right accounts on to the right people will make a huge difference. The other thing as well, let's say that Ray is the single beneficiary and Ray and Veronica's kids are the contingent beneficiaries. Well, Ray doesn't have to inherit the account. Ray can inherit part of the account, the whole account, or none of the account. If he disinherits the account, it will go to the contingent beneficiary. Well, in this case, that might be Ray and Veronica's kids. Well, if Ray and Veronica's kids are in their early 20s or 30s, one, they'll probably be in much lower tax brackets and also can use that money just as much, if not more. So again, disinheriting an account and letting it pass to the contingent in specific cases can make a lot of sense as well. And transparency, I understand that in reality, certain planning, including your tax situation along with your parents' tax situation and talking through that, I get that people don't like to do that as much. I'm just telling don't have as many options then. Okay, another important point is around Roth or Roth IRAs, inheriting a Roth IRA. You have the option, or when you inherit a Roth IRA, if you're a non-spouse, you follow this 10-year distribution rule. Now we know that pulling money from a Roth IRA will not add to our taxable income. So taxes aren't really a factor here. But I would highly recommend, if you don't need that money, delay RMDs till the end of that 10-year distribution. Why? Because I'm guessing that money is going to be invested that whole time. Well, it's invested in a tax protected account. So let's say you inherit $600,000 Roth IRA. Well, you could take that full distribution in the first year. There's not going to be any tax implications for doing so. But if you leave that, I'm guessing you don't have a need for $600,000 in a given year. So you're going to be putting that into a different account. I'm guessing you don't need that full $600,000. So you're better off taking whatever potential distribution you might need for income, but leaving the rest of that growing in that tax sheltered account, taking that full distribution 10 years in. Okay, so if we assume that's going to grow at 6%, $600,000 grows to almost 1.1 million, all tax-free, all tax sheltered that entire time. So delay RMDs from a Roth IRA. The next question then, if you're subject to the 10-year rule, what is the best way to distribute? Should you distribute equally, periodically? Should you do a lump sum in a given year, do multiple lump sums? And this is going to be a layered question. Unfortunately, I'm not going to be able to give you a specific answer for your situation. There's two things that we need to consider. The tax rate, that's very apparent and very obvious. If we take a distribution, if we go up into the next tax bracket, we need to be calculating that and assessing that, but also penalties and hurdles. So in the Ray and Veronica example, they wouldn't want to take periodic withdrawals because they would lose their subsidy for those first 3 years. Well, that's a penalty, a hurdle that we need to include and factor in. So let's say you inherit an $800,000 IRA. Let's say that money is going to stay in cash. Well, equal distributions is pretty simple. $80,000 a year. An $80,000 distribution for most people is going to probably bump them up into the next tax bracket. Okay. The thing that we need to be factoring in is penalties and hurdles as well. Okay. Maybe they're still working. Maybe they won't see as many penalties and hurdles, and this will be completely fine. Spreading out that tax burden, that might be fine. But if in these first 3 years, just like in Veronica and Ray's example, if they're going to lose a subsidy, you probably either want to take big distributions in this phase or don't take any distributions at all to earn that subsidy. A $12,000 a year subsidy is a huge deal. Okay. Then from there on, obviously we see equal distributions. Well, most of us are going to be investing that money during those 10 years. So you need to be factoring this in as well. This is going to make it almost impossible to take equal distributions because we don't know what the growth is going to be. Growth over the last 10 years would have been a lot better than growth from 2000 to 2010. Okay. And so if let's say they start taking these equal distributions, but their account's growing. Well, all of a sudden we notice that in the last year, even though they've been taking these equal distributions, they now have $258,000 left that they have to pull in that final year because of that growth. And so you're likely, when you're taking equal distributions and also investing that money, you're likely going to have to be taking distributions that grow something like this, okay? Because again, with the growth and whatnot, we're going to be taking larger and larger distributions. So this over here, we're going to be taking a lot larger distributions unless we're just going to kind of bite the bullet here in this last year. Lump sum distributions. Again, depending on how many hurdles that you might see in your situation, it may make sense to lump sum all in 1 year. Okay, so maybe for Veronica and Ray, they should have taken that full $500,000 distribution in that first year. Okay, yes, they would have been subject to some of the highest tax brackets from a federal income standpoint, but they would have only lost that subsidy for 1 year. They would have gone back to earning that subsidy for those final 2 years. And so again, this is all going to depend on your situation, what your tax rate is going to look like, what other penalties and hurdles you have to overcome. What other penalties and hurdles are there? Well, we'll actually talk about that in a sec. But in this situation, when we factor in Growt, $800,000 IRA, let's say they want to lump sum it in year 3. With Growt, this might be something more like $900,000. So that's an option as well. Again, it's just going to vary and vary widely depending on your situation. The other thing I would note, though, is we can growth coordinate your accounts. So we've talked about growth coordinating from investing in a Roth and investing in a traditional IRA, meaning that you want to invest the Roth more aggressively because you want more growth from that Roth. You want to invest your traditional IRA with a lower growth vehicle because that is your tax burdened account. Well, the same growth coordination can happen when we're talking about inherited accounts as well. I will say for either your account or an inherited account, if it's a Roth IRA, we still want to generally invest that more aggressively because we want that growing as large as possible. But from a traditional IRA standpoint, what I would say is you want to invest the inherited IRA, traditional IRA, you want that to be your safest vehicle. So if you're keeping cash, let's keep it in the inherited IRA because you're forced to take out that full balance in 10 years. So we want to minimize that balance as much as possible. So out of every investment that we hold, let's hold these slowest growing investments in those inherited accounts. With your IRA, you're going to be subject to the RMD table. Once you turn 72, it's going to increase slowly. It's not 10 years, it increases slowly. So again, growth coordination wise, safest stuff in inherited accounts, unless it's a Roth IRA, then we might want to still invest that fairly aggressively. So when we talk about penalties that you need to factor in, what penalties might we be talking about? And this is not an all-encompassing list, but these are a few big ones. Healthcare premium increases, both on Medicare as well as Affordable Care Act insurance. If you take too large of a distribution from an inherited traditional IRA, guess what? Your Medicare premiums can bump up as well. We need to be factoring in your own required minimum distributions. Okay, you might be in a situation if you inherit an IRA after you've turned 72, you might have to take your RMD as well as an inherited RMD as well. Well, let's say they're both 6-figure RMDs. All of a sudden, you're subject to a lot of different penalties. So we need to be considering your own RMDs. Social Security tax torpedo, the double taxation. If you take more from your retirement accounts, causes Social Security to be taxed, essentially you're double taxed. We want to be factoring that in as well, trying to avoid the Social Security tax torpedo. Net investment income tax is often referred to as an Obamacare surtax. It's the extra 3.8% capital gains tax that you might owe if you're married, filing jointly, if you have a AGI over $250,000, or if you're single over $200,000. We need to be factoring in the Tax Cuts and Jobs Act. Okay, if we receive an inherited IRA right now, we may want to take a lot of those distributions over these next few years while taxes are low versus after 2025. And then also the widow penalty as well. We want to be factoring in all the penalties created because of that widow penalty. So here are a few other factors you might want to consider as well. With Ray and Veronica's situation, we talked about their current tax planning strategy and how that inheritance really messed up their situation. So obviously you want to be factoring that in. It would have made more sense for Ray's mother to start performing Roth conversions while she was still alive rather than passing that on to Ray and Veronica. Here's a big one. Are you planning on moving to a no income tax state? So we live in the beautiful state of Wisconsin. Most people are going to be taxed around 6% for state income tax. Okay, well, if you're moving to an alternative state like Texas or Florida that doesn't have a state income tax, you're essentially saving 6 to 7% in taxes by doing so. Well, if you inherit money right now, and next year you're planning on moving to a no income tax state, it might make sense to not take a distribution this year, but wait until next year and avoid that state income tax. The other thought as well is, who are the contingent beneficiaries? Remember we talked about disinheriting an account? If your contingent beneficiaries are people that you want to receive that money, or I should say if the deceased owner's contingent beneficiaries are people that you want receiving the money, you might be better off disinheriting that account. Yes, you will not receive that inheritance, but you'll avoid the tax hurdles, and the people you want getting the money will get the money anyway. And so in summary, there are essentially two different regimes that we have to start planning under. I will say, if your estate plan did not change because of the Secure Act and your advisor didn't go over those changes with you, I'd highly recommend you take a second look, get a second opinion, because there is so much that changed because of the Secure Act that your plan needs to change accordingly. Again, inheritances are a fantastic thing, but they also need to be planned for. You know, oftentimes when we're talking through some of these ideas and talking about how, you know, at the end of your life, a Roth conversion might make sense to avoid setting your children with a tax burden when they're early in retirement. Sometimes I hear an objection like, they're getting $500,000. They should just be happy they're getting $500,000 and just pay whatever taxes they owe. And if we think about it, that objection doesn't really make that much sense, because the whole point of you passing money on to the next generation is you want that next generation to receive the benefit. Otherwise, you should pass money on to somebody else, some other cause that you care about. Well, if you pass that money on in an inefficient way, Uncle Sam's going to be the only winner out of that situation. You're not going to win. Your heirs aren't going to win. And so including tax planning as part of your estate plan is paramount. Ideally, we want to start beginning a multi-generational plan around this money to make sure we're factoring in not only your tax rate and your tax hurdles, but also your heirs' tax rate and tax hurdles, and distributing in the optimal way. Keep the majority of the money in your family and not in Uncle Sam's pockets. So let me know if you guys have any questions here. I know a lot of you will probably be watching this as a replay, and so feel free to include a comment if you have a question. Otherwise, always remember, you don't need more money. You need a better plan. You need to both take an inheritance in the right way, have a solid inheritance strategy, but also pass on inheritances in the right way as well. Make sure you're following the RMD rules that you have to follow. Otherwise, there's a 50% penalty for not compliance. So again, you don't need more money. You need a better estate plan. You need to deal with inheritances in a better way. Always remember, guys, or I should say, thanks for watching, guys. I was going to say always remember, but I've said you don't need more money. You need a better plan twice here. So probably don't need to beat a dead horse on that front. Thanks for watching, guys. Hopefully this was informational. We'll see you during next Wealth Wednesday. All right. Have a great one, guys. Bye.